The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I have with me here Gaurav Sodhi in leafy northern Sydney and Graham in probably cold Vancouver, and I am in perpetually cold Melbourne. We're going to kick things off this morning by talking about founders. There's lots in the news, especially around Richard White at WiseTech and Ellison at MinRes, which is a stock that we have been quite keen on recently. So let's start things there. Gaurav, what's going on at MinRes at the moment?
Geez, what is going on? That's a question I'd like to ask, actually. I should be asking that question rather than answering it.
I think the directors or ASIC should be asking that question.
Yeah, it has been a complete shit show, John, at MinRes. I mean, the company is dealing with. So let's step it back a little bit and explain that MinRes is on the brink of bringing on one of the largest new iron ore mines in the world. Certainly, the largest investment project in that company's history. It's about $4 billion of investment. Remember, this is sort of a $8-9, or probably smaller now, $8 to $9 billion business when that decision was made. So they're trying to grow the business by sort of 50% on an asset basis in a short amount of time. They took on a whole bunch of debt to do it, and they've got some project partners, and they're actually funding the entire project by themselves. Including their partner share, and they'll sort the revenues out a little bit later. But it's just meant that the company has already been under a fairly large debt load and has had to sit there with a whole bunch of debt while the project gets built. And it's now generating iron ore sales, and it will hit its nameplate capacity mid next year. So it's under a fair bit of pressure to get that operating part of the business right.
And this is the Onslow project.
This is the Onslow Iron Ore project. Tremendously important. I mean, it's a fantastic project. Tremendous economics. Can transform this business.
It's kind of a Fortescue kind of
It is a Fortescue moment, yes. And they're using really innovative technology to make this happen. Iron ore projects are really hard because, as I always say, I should put this on a T-shirt. Iron ore is an infrastructure business. It's a logistics business. It's not a mining business. So you've got to build and run a whole bunch of infrastructure to make it work. And that's what MinRes is doing. But while that's all happening, all this news in the background has popped up about past misdeeds by specifically the MD, Chris Ellison, and some old board members. Now, much of this relates to things that have happened over the last 15 years or so. Much of it relates to things that have happened pre-IPO. So it is old news, but it is really bad behavior.
Well, the new news is the announcement that this happened a long time ago. And the reason why the Fin Review is writing about this regularly is because of the way the board has not disclosed this to shareholders. It seems to be very current from a settlement point of view. And it seems to be very current in the way that the details about this are just dripping out now. And each time you get more details, it looks worse and worse and worse, which seems to be typical of these kind of situations. You have one bad thing and the cover-up makes it far worse. And then the details come out and it becomes a protracted, prolonged, painful disclosure process when it could have been done quickly and cleanly.
Yep. And what it points to is a pretty feeble board.
Yeah.
That probably hasn't done its duty all that well in restraining management behavior and supervising management. It's really hard to do when the person who's supposed to be supervising is Chris Ellison, who is the founder, the natural leader of that business, and a 12% shareholder.
So this does bring us to the founder problem.
Yes.
I think about this in the way that, say, board capture at Qantas with Alan Joyce, and he's clearly not the founder, but somebody with a dominant kind of personality who has a good track record of running the business can eventually become dominant over the board, and the board becomes subservient to the CEO rather than the CEO reporting to the board. Graham, what's your view on the downside of the founder mentality?
Yeah, it's always a bit of a tug of war because on the one hand, you want a founder-led business. They tend to be better run. You've got someone with skin in the game who usually thinks of the business as their baby and so puts in, they're doing it for more than the money generally. But I think I think the board and investors can tend to just be captured by that initial run for the business where the founder is generally, if it's on the ASX already, then the founder's already generally built it up from something tiny to something larger. And so there's a lot of faith put in them. So, yeah, I think there's that overemphasis on this kind of hero of running the ship. And yeah, the other downside for them could probably be that you can become complacent as the founder. If they've been there taking it from 0 to 100 million of sales or whatever, $1 billion of sales, can require a very different skill set to maintaining a business or growing it even further when it's already in a mature market, when it's already had that initial good run. So you might need a different manager when the business is much larger, but that may not be obvious. There's usually not some obvious sign that that's happened. But there's also the other argument that you don't have to be a founder to run the business well either. So I think of someone like Brian McNamee, who ran CSL for 20 years. He inherited the business. He basically had no large shareholding, anything like that. And yet no one complains about how he did it. So it's not that you have to have a founder or you have to have a big owner manager to get these businesses to work.
I think that's true. And I would say that usually founders aren't the people who are the best place to run a business once it's been established. And maybe that's something that shareholders in MinRes or even WiseTech would consider. I suppose, Gaurav, the problem is that MinRes is that because this Onslow project is so big, it is still kind of a founding stage, whereas at WiseTech, I think Richard Wright might be able to leave. And the mechanisms in place, the culture that he's established in terms of acquiring new businesses and rolling them into the existing kind of software base that they've got, the code base, could be replicated by another manager. But could you make that argument at MinRes, or is this project and where the company's at dependent on the founder?
It's not just this project. The distinction I'd make between WiseTech and MinRes is I think MinRes, the capital allocation of the management, say, not so much the founder, but the capital allocation of management is way more important and puts the business under much more risk. I mean, WiseTech is a software business where you just spit out lots of free cash flow. And you don't really have to reinvest all that much to grow. You know, you've got a suite of software there. I mean, there are historically lots of acquisitions, but when WiseTech is making acquisitions, they're opening beachheads in new jurisdictions, and they're often buying the license requirements and the regulatory approvals rather than buying customers or trying to beef up revenues.
It's quite different from starting a mine.
It just does not require the same attention to capital allocation. Whereas I think the great strength of Ellison and the reason why he is so revered by shareholders and apparently his board is because he has demonstrated 20 years of amazing capital allocation in an industry that's renowned for lousy capital allocation and huge losses and empire building. And that's what distinguishes him, and that's what gives him his aura. Now, these two examples, you know, they've kind of dented this image of the founder, but I still am a big believer in founder-led businesses. I mean, John, you're a founder yourself. I think it takes a certain type of person to build a business from scratch, persist with all the problems. Everyone's going to tell you you can't do something, and you have to believe that you can. There is a particular kind of arrogance in a founder and an irrational persistence that you will never get from a professional manager. And so the question I have for you, John, is just how many houses have you bought? And what is it hiding in your closet?
Well, I can tell you I don't approach young female founders on LinkedIn seeing if they want any help. And I think that sort of gets to the nub of the issue. Like, I think the best example, you know, beyond Richard Wright and say Chris Ellison is Elon Musk.
Yeah.
where you've got to be absolutely crazy to think you can take on the 100-year-old auto industry and fundamentally change it. And you've also got to be slightly mad to think you can take on NASA and build rockets that can land back on the platform that they took off from.
Every engineer in the world is telling you it's impossible. The agency that landed people on the moon is telling you it's impossible.
That's right. That's right. So the question, I think, for investors is whether the mentality you need to get something going is the mentality you need to run it once it's established. And also, the big bets that Ellison took and Musk took, and having those pay off, does that necessarily lead to a kind of arrogance and this kind of self-inflation that ultimately eliminates all sense of humility and all sense of sort of anchored to a world that most people inhabit, that allows them to behave in ways that are just completely unacceptable and people wouldn't tolerate, but they see as being almost entitled to do so? And I think that the
answer there is
go on.
You have a combination right there, right? You've got someone who's slightly mad to begin with, and then you've got every heuristic and bias is confirmed about their own brilliance by the results they generate.
Right. Which is why you have a board.
You're right. Yep.
And when the board fails and becomes a kind of extension of the CEO's ego or persona, then you can get into real trouble. And I have to say that the MinRes thing really does worry me. And I think MinRes is, or Chris Ellison is probably more important to MinRes than Richard Wright is at WiseTech. But you can see that sense of capture in the deal that Richard Wright has done with the board. It's astonishing that he's effectively CEO, and the only change in his role is his job title and the fact that he doesn't now have to disclose the kind of transactions that he would have to disclose if he was sitting on the board. And if that's allowed to stand, and I can't see how it will be, it definitely should be banned, then you actually remove any kind of accountability to CEOs because you just don't call them CEOs anymore.
Isn't the behaviors we're looking for really, I mean, there's nothing magic about being a founder, but the great thing, being a founder is a proxy for long-term thinking. And I think that's what you don't get with professional management. And Joyce, compare Joyce to any founder, and you have a really good illustration of what's wrong with professional management and why we prefer founders, right? Joyce was in that business to hit his targets and to earn his bonuses. And there's a good argument, and Joe Aston makes this in his book, that he has stuffed the long-term reputation of the business. He's basically hit all his performance targets and his profit hurdles by pushing back capital expenditures and leaving Qantas with a fleet of old and aging planes.
Yeah,
that will
I think
we'll
there's
have
no
to
doubt about that. But he would say in his defence that Qantas are, a government-mandated monopoly and are going to make money no matter what, and that's probably true.
Well, I don't know. I don't think that's true at all. You've got a really competitive international business there. The Singapore, Emirates, Qatar Airways, they're all investing in new planes.
It's a domestic monopoly.
It's a domestic monopoly.
Yeah.
And even for Joyce, I think that it still just comes down to the board, how they're setting the incentives. And so if he's just matching his incentives and doing what the board is paying him to do, then I think it's harder to blame him versus, I don't know, someone who really goes against what the board is asking of them. So I think in that case, it's the board's problem for not setting the incentives right and putting the performance hurdles kind of in the right boxes.
Yeah. No,
I think that's right. If you're going to blame anybody for the Qantas schmozzle, then Richard Goyder is a better target than Alan Joyce.
Yep. No, I agree with that.
Okay. Is there anything else you want to say on the founder mentality? Because it is kind of this hallowed shibboleth of value investing that you're much better backing a horse who's got, what was Paul Keating's phrase? The
desecrated
the only
coconut
horse that's trying. And I think that's true, but you do have to be careful. My mind goes back to Strathfield Car Radio, which is a chapter in in the book on
Oh, there it is.
my
There's the plug.
greatest mistakes. And I don't want to go back to it, but I'm going to go back to it because it's a great example of how if you just follow a founder blindly, they can lead you to disaster. Because if you think that you're committed to a stock after the share price has fallen 50% and you've hung on, and in fact you may have bought more, then think about the founder. They are so much more committed than we were. And I forget the name of the CEO now, which is kind of amazing given how much I've read about Stratfield Car Radio over the last 12 months. But they were buying, the CEO and the board were buying all the way down. And we thought, follow the smart money. There's value here. We can see it. They can see it. How can this be wrong? And the fact is, they were even more wrong than we were. And their confirmation was the same as ours. And they just couldn't see what was going on around them because they had this previous success and they were very committed and they were buying more shares, and we followed it all the way down.
I wonder the extent that the board was watching the founder and so thinking, well, he obviously knows what's going on. So even if we don't think so, then...
Yeah, that's right. Okay, let's move along. We have some news from Cochlear, which another chapter in the book, probably the most painful one of all, having sold out at $86 in, I think, when was it? 2015. Graham, what's going on at Cochlear?
Well, Cochlear has a very unusual threat going on at the moment, which is a vaccine. You don't usually think of a hearing implant maker as being threatened by potential vaccines. That's usually something that would affect the likes of CSL or, I don't know, companies that produce some drug that treats an illness that can now be cured by a vaccine. But in Cochlear's case, that is actually what's going on, where at the moment there's a phase 3 clinical trial for a drug that can, for a vaccine that can prevent cytomegalovirus infections, CMV it's called. And yeah, the issue for Cochlear is that CMV, it turns out, if it's contracted by a mother and then passed on to the fetus, that can ultimately result in deafness for the child that's born, for the newborn. And around 20% of all children's deafness is caused by CMV infections. And so to suddenly have this vaccine, which can reduce that or eliminate it, then suddenly this is CSL's most valuable market, children, because they have a multi-decade run of processor upgrades once they get the Cochlear implant, that, this vaccine could suddenly severely reduce that number of, or that pool of potential recipients.
Is this another thing that Ozempic can fix? Is the vaccine Ozempic? It seems to be a cure for everything.
Yeah, who knows?
Can it fix my hangover?
Maybe.
Well, there's a world where that can actually work. So, Graham, this sounds like a really big deal. I'm surprised the share price has not reacted more to this. You're saying this vaccine is now in stage 3 trials, is that right?
Yeah, so it's not over the line yet. The final results will only come out in early 2026. So there's probably going to be some preliminary results out before then, maybe even early next year. So I think there will be a share price move on the day of the results. Some people would be watching this quite keenly. But I don't think it's going to have as big an even if it was approved, it may not have as big an impact as it sounds, because even though the vaccine could eliminate, say, 20% of the childhood deafness market, the effect of those kids on revenue is there's an upfront headwind to Cochlear because it's going to be selling 20% fewer implants to that group. But the real value will only kind of trickle in over time because you're missing out on all those future processor upgrades. So although it'll affect maybe 5% of sales very, very quickly, maybe within a few years of the vaccine being approved, the full effect on Cochlear's revenue would only be over 20 years or so. And even then, it might affect it by, say, 10 or 15%. That could be the kind of ultimate hit by this. So it is a drawn-out effect, so it's nothing to kind of freak out about, even if it does get approved. And in the meantime, you've still got a growing market. Generally, the adult population demand from that group is still growing. So by the time you get to that 10 or 15 years out where the effect of the vaccine would kind of be filtering through, the overall market would probably have grown significantly by then anyway. And so you may not even notice it showing up in the accounts. It's going to be a case of missed opportunity rather than some immediate dramatic hit to Cochlear's profitability.
I see.
Okay. And that explains why the share price doesn't seem to have reacted to this possibility.
Yeah, it should in theory. I mean, that if, say, 2 years ago, the company was going to make an extra several hundred million worth of sales out of these children that are now, well, they're now unborn and they're going to be cured if they were born. But yeah, that's still a missed opportunity that the company had a couple of years ago. So I think that it should show up in the accounts, but I guess it's not causing the dramatic share price reaction yet. But I'd watch it on the day of the release. I think that'll have some sort of a effect, especially if the media pick it up and they start saying Cochlear is doomed because there'll now be vaccines for deafness. And
are there any other things like this on the horizon, Graham, that might dent Cochlear's potential sales? I had no idea that you could become deaf from a virus.
Yeah, honestly, I didn't either until I started looking into it more. But yeah, there's always things that are going on in the background that could affect Cochlear and all of the other medical companies, because I guess there's always drugs in clinical trials. In terms of vaccines for Cochlear, I'm not aware of any others that are really on the horizon that could be affecting this. This was quite a big one. But there's always, I think one of the big effects which might go through is other companies are working on embedding their implants with different drugs which can improve the result and kind of reduce the damage to the ear the implant produces, which could, if Cochlear doesn't kind of match that with its own drug-infused implant, then that could lead to, I don't know, quite a big change in how doctors perceive them. One being, even if Cochlear has the more advanced technological implant, they might favor one that does less damage to the ear as well, because the cochlear implants do still damage the ear when they're being surgically implanted. So yeah, that's one that I think could occur over the next 5 years or so. But yeah, we'll see.
Can we just talk a bit more broadly about Cochlear? Because I've struggled with this company actually. This is a bit business. What, it's $20 billion odd? Would that be right, Graham?
Geez, I don't know it off the top of my head.
Yeah, okay, but I think it's something like that, something like 20 billion, maybe a little bit less, but something like $20 billion market cap, which in terms of giant healthcare stocks is not all that large. A technological marvel, easily the best of its kind in the world. Yet the top line growth has not been all that swift, and it is trading at something like 50 times, late 40 times earnings, and it just seems to be a perpetually expensive stock for a business that isn't growing as quickly as one might expect.
Gaurav, what's the matter with you? Haven't you moved with the times here? Like the world has changed.
It's still in double digits, I guess. It's
50 times earnings. That's cheap, man.
50's the new 20.
Yeah. Well, it's not doing too badly. I think revenue's growing at kind of double digits, low double digits.
Yeah.
And yeah, if it can grow at 10% a year, then that's, I think, fine for a PER of
50
40
really?
or so. Well,
yeah.
You got to think that if it can grow at 10% a year revenue, profits will definitely grow at a faster pace than that, because there's a lot of operating leverage in the business. And so let's say you're getting, 13% growth in earnings, then, I mean, if it's trading at 40 times earnings, that kind of vanishes pretty quickly. The other thing with Cochlear is that compared to these flashy companies that are growing at much faster rates, Cochlear's, I think, is a lot more built in. The children that have implants now, they're locking in that revenue for decades. So it's a much more certain growth rate. And so maybe you can go to the companies that are growing at 20% or whatever, and it seems easier to justify the higher valuation. But Cochlear has a lot more certainty, and it's kind of still decent, but middle of the range growth rate. So you're paying up for that.
Do you think there's any danger, Graham, from, you know how Apple AirPods are going to have this hearing aid function?
Well, not really. I think that if anything, Apple and the connectivity to phones has been a big benefit to Cochlear because they were quite ahead of the curve in terms of connecting wirelessly or connecting through Bluetooth to phones and that kind of thing. So yeah. I think so far, because Cochlear really is the standout in terms of its technology, it's always been a beneficiary of kind of anything that improves its usability. And so, yeah, connecting to phones, connecting to hearing aids. Cochlear has a big hearing aid division as well. So it's not just the implants. It's really a hearing solution provider. I'm sure is how I would pitch it.
Graham's marketing skills are coming to the fore now.
Yeah. So anyway, getting back to
Graham.
Yeah, exactly. AI enabled. I'm sure they'll be talking about that soon.
So are you saying, Graham, that the recommendation is unchanged? We've got a buy price that's below 200. It's going to have to fall a long, long way before we can get this company back on the buy list. Is that your view?
Yeah, it does need. It is trading at a high valuation. I think it's actually not as crazy as a lot of people think. I mean, most stocks that are on a 40 or so P seem outrageously expensive. Well, maybe not Gaurav stocks, but for some stocks, for the average stock,
it's only on the same valuation as Reese. I mean, this and a plumbing supply business should be on the same valuation, right?
Plumbing supplies and bionic ears. Yeah. Gaurav,
so
you sound more skeptical.
I don't think it's particularly overvalued. Ironically, I think that because it has such a guaranteed kind of growth rate built in, I really find it difficult to imagine, apart from some sort of left field product recall or something like that. It's hard for me not to justify today's share price. That doesn't mean that it's a buy at today's share price, but in terms of if you already own it or you're looking to hold it for the next decade, then I think it's fine.
Yeah,
at what it's trading today.
I take your point, though. It's not as outrageous as other businesses, and Reese is the whipping boy of the moment. And that's one. But we've gone through the list many times. There is certainly a collection of businesses on the ASX where the market's really crowded around, and they're well loved, and they're well held, and they just do not stumble. And there's a growing confidence that those are the only places I think you can earn your returns. And that sort of consensus really worries me. I mean, perhaps it's just my my inner weirdo talking. I don't like to be part of the consensus, and generally frightens me.
No, I don't think that's being weird at all. I think that's being sensible.
Yeah.
It seems obvious that high quality businesses are historically way above where they traded in the past.
Yeah, but they're also they're also high quality businesses, and most people have underestimated over time the returns you can make just from that high quality tier. So it's certainly not a slam dunk argument, but I take your point. This probably belongs in that category. But Graham, this is a very good quality business, and I see your point of view as well.
Mm-hmm. I mean, I'd rather buy Cochlear. Given the choice of
Cochlear and Reese,
Cochlear at today's prices, and Reese, I'd choose Cochlear. I think.
Well, Combank's on 25 times.
Yeah.
Right?
Yeah. I think some companies you're paying up for the growth rate, and others you're paying up for the quality. And I don't know, paying up for quality that's genuinely there seems like a safer bet to me than trying to find the fast mover that could, easily contract instead of grow at 50% a year.
And the moat here is just so wide and impregnable.
If you gave me Cochlear at today's share price but said I had to hold it for 20 years, I wouldn't lose any sleep in the next 20 years. You just hold on to it. But there's plenty of the highly priced companies today that they might not be around in 20 years, so it'll be a bumpier ride.
Thanks, Graham. Let's just have a quick chat about field trips, because a couple of weeks ago...
Thank goodness. I thought you were going to say AI. Every time someone says, let's have a quick chat, it's almost inevitably AI.
It's okay. Angus isn't on this podcast.
Thank goodness.
So we went up to Brisbane and we saw a couple of companies. We saw AP Eagers. They've got an auto mall in Indooroopilly shopping centre.
And for those of you who actually speak Australian English, that's auto mall.
Or, was that right? Sorry.
It took me
I
a
thought
couple of
this was a
days
good
to
bit
understand what you were
like,
saying.
let's just own up to the fact that you really struggled with saying Indrapilli when you saw it written
Yes,
down.
I did.
And I can understand why. It's ludicrous
really did.
sort of mispronunciation, but I
Yeah.
did get the hard part right there. So what was it? Auto Mall.
Yes.
Okay, we went to an auto mall in a shopping centre in Indrapilli, which is quite illuminating. And then we went, the next day, we went to a second-hand car lot in Nunda, near Brisbane Airport, where we saw I think it was about 350 cars under one roof, which was Eagers Easy Go
Auto.
123.
Easy Auto.
Easy Auto. 123 more. And then the next day we went down to see PWR, which makes heat exchangers for Formula One cars and is currently getting into aeronautical and other kind of products. Does it change your view of a business or change your understanding of a business when you get to see it in the flesh like that, do you think?
Field trips are interesting. So we've started doing a few more of these. And for me, I think you need to it's a bad idea to go visit a business blind. I think you get the most out of a field trip when you have a good understanding of a business and you have an idea in your head, and the trip is there to confirm what you have in your head or to slightly alter it. You need an image of what the business looks like in your mind first, I think, before a field trip can be useful. And for me, I think I understood Eagers relatively well. I think that used car business was particularly useful to see. That's not a part of the business I have focused too much on, and I'll write a review of the used car part of that business in some time. But PWR was particularly useful because the business I followed for a long time, and I thought I understood that company quite well until I saw it, and then I think it really enhanced my understanding of the business, seeing how it operates, and in particular, what you can't really see in the reports and in the presentations is the vibe. You know, when you've been doing this job a long time and you meet a lot of companies and you see a lot of business models, you start getting good at picking up on vibes. And you know, we laugh at that because it's from the castle, and of course it's ridiculous. But there's also it's a shorthand for pattern recognition. And once you recognize, if you've seen enough businesses, you start to recognize the special ones, and you'd have to go and visit them to pick up what's special about them. PWR was arguably one of those businesses,
and that's probably a good point that they work going and seeing the business in person versus just analyzing it from reports is they kind of go hand in hand, because if you didn't have that background in the reports, you wouldn't really understand the business very well when you're there.
Absolutely.
And it's at least for me, I think it's very easy to go to businesses in person and be impressed. You go to a factory, you see all these moving things and shiny stuff, and suddenly it feels like this really great business. But if you look at its financials, the boring stuff in the report, you can then realize, oh, it's actually terrible for all of these reasons, no matter that it's got all this flashy mechanics in real. And the same probably goes for the vibe, where you can go to places that have a good vibe, but the financials don't kind of back it up. And at the same time, you can go to places that have a bad vibe, where the financials can kind of represent that in a way that it's flowing through to the numbers.
Yeah, no, I completely agree. And in fact, it reminds me of a trip I took early in my analyst career to Brickworks. One of the first companies I think I visited, and I was just wholly unimpressed by the brick manufacturing business. And what I didn't realize was that I was looking at the wrong thing. It was just not an important part of the business, and the important part was actually the location of the plant, the location of the quarry, and what was around it. Like the potential for property redevelopment was much more powerful than the dustiness of the machines, or the lack of workers, or the poor enthusiasm, and you know, there was a poor vibe at that factory. That just was not important. And so if you don't understand a business, you're not sure how to weight what's important and what's not.
Yeah, I think from a marketing point of view, I really benefited from seeing the Eagers second-hand car operation. just to walk in there and see the range, and also to see the things that they focus on. Because I think when we walked in, Gaurav, and this will be in a story on Friday where we're going to look at it from a marketing point of view. But you're saying, what's this 1, 2, 3 thing? You know, why do they call it that? It makes it sound easy, but you know that that's going to be tied into the marketing somewhere. And that was just reinforced with these huge kind of banners on the side of the walls of the shed, this giant shed. And everything was orientated towards reassuring people that this is going to be a relatively painless way of buying a new secondhand car and driving out of there knowing that you haven't got a dud and you haven't been ripped off. And that is something that I only really gathered from being there. And I've never bought a new car, as you know. I'm not a car person. I'm a bike person, which is, you know, a lot more dangerous, but also a lot cheaper. But I could have gone in there and felt, okay, I might be paying a fixed price. I don't have to haggle. I don't have a horrible salesperson who's giving me these high pressure tactics. For me, that was an incredibly valuable thing to understand, and also the integration between the secondhand car business and the new car business as well, which isn't something that I really got from your reviews in the past, Gaurav. It just gave me a sort of depth of understanding of how this business makes money and what the appeal is to its consumers. And it's a really important thing. You know, if you're looking at a business and being able to answer, you know, how does this thing make money, and does it actually really solve a problem? And that solves a big problem, I think, in the secondhand car industry.
And Graham, you missed the trip, so you didn't see John's psychological warfare against the staff and how good he was at extracting information they did not want to give him. So we actually learned a lot, and we can't necessarily talk about some of the stuff we learned, because I'm not sure they were supposed to tell us, and this information we're probably not supposed to have.
No, they definitely weren't. We had to try 3 people before we got anything really useful out of them.
But that's the other thing. Sometimes when you go to the business, you can gain an information edge if you're clever about it the way John was, and if you talk to the right person the way we did. So there's that as well, which doesn't work if you're just talking to the CEO or the top level staff.
Yeah,
it's
just
so much better.
Yeah,
the more lowly staff that are the ones who are
often
get the more useful information out of.
Definitely.
Yeah, I totally agree with that. I find it counterproductive often to talk to management, but I can't think of any times when I've spoken to lower level staff where I didn't learn something that was genuinely useful or interesting.
Yeah, that's right.
So I think we're going to try and do well, we have been doing more of that, but I think we're going to continue to do more of that. Just try and intelligently use field trips to understand these businesses a little bit better.
Yeah. I mean, I think it's a great idea. It was a lot of fun too. It was nice hanging around with everybody. We don't get much time in the office together. We're going to try and change that as well. But field trips are great. And Gaurav, I'll keep hassling you to get on a plane and go to Onslow or wherever it is in West WA. You can take the children with you if you like, but send us some pictures of what this mine looks like, and the equipment that was sold at 4 times the price it should have been to MinRes sitting outside the sheds.
Well, the lunch over at PWR was probably the best AGM lunch easily the best AGM lunch I've ever had.
Easily.
So I was going to take my son next time to.
Yeah. Do you think that's a warning sign?
It often is. It often is. But I think there are special circumstances in this case. They have their own kitchen on site because they're quite far away and they've got to feed their workforce.
Yeah. Yeah, that's right.
Yeah.
Okay, I think we'll end it there.
Where did we start? We started on founders, and we're ending with kitchens, and somewhere in between, I'm pretty sure we mentioned a stock or two. But
we did, yeah. Let's apologise up front for this podcast. Sorry, everybody. We're not going to record this again. We've had enough problems already. We're all going to say goodbye.
Yeah.
Thanks very much, Gaurav.
Thanks, guys.
And thanks, Graham.
Thanks, John.